Australians look set to remain poorer for longer, on the back of interest rates and inflation that are going to remain higher for longer. This at least according to the latest document coming out of the RBA, which has signalled stubbornly low wage growth, at least in real terms, but persistently high inflation and the likelihood of very high interest rates, which are really going to adversely affect a lot of people. And to some extent, this seems to be the point. The point appears to be to try to corral people into spending less money. But at the moment, you've got people who are savers, who don't have debt, who are able to just save more and more money when interest rates go higher, and then you've got borrowers who are now being saddled with increasingly expensive interest rates. So some people are getting crunched, some people are doing amazingly, and then you end up with this average that isn't really actually reflecting the true state of the economy. But nevertheless, we can look at what the RBA said and analyze it a little bit. And if you've got any thoughts about it, well, let me know that in the comments below. So the RBA stated about growth in Australia. Growth in the Australian economy is expected to remain below trend over the year ahead, as cost of living pressures and higher interest rates continue to weigh on demand. GDP per capita is expected to decline over 2023. So we can see here a couple of things. Firstly, the RBA throughout the whole statement does indicate that GDP growth is going to remain in positive territory. They're not predicting a recession, but also they're expecting sluggish GDP growth. And in particular, on per capita terms, things aren't getting very much better. That is, the amount of economic output per person appears to not be improving very much. And the RBA throughout their statement also emphasizes issues with productivity. That is, the amount of units of output per hour worked appear not to be going up. And in part, that could be because real wages are going down and people feel less motivated and or they're picking up second jobs rather than working unpaid overtime at their existing one. But in any case, the RBA is expecting some positive GDP growth, but not stellar GDP growth. They state, growth in the Australian economy is expected to remain below trend over 2023 and 2024, as cost of living pressures and higher interest rates continue to weigh on demand. The RBA states on the labour market, the very tight labour market conditions over the past year have begun to ease, as labour underutilisation rates are expected to rise gradually over the forecast period, given below-trend economic growth. The easing in labour market conditions is forecast to be more gradual than previously expected, because of the stronger outlook for aggregate demand. And in terms of aggregate demand, in part they're referring to immigration. That is, there's a large number of people moving to Australia, whether they are international students or people moving to work here, and this is driving up demand to some extent. But of course, this then also drives up inflation. Now, it does drive up to some extent the number of employees, but it appears the demand effect is outweighing any supply effect on getting more employees into the workforce. In part, this could be due to visa issues employing people when they move to Australia, because companies appear to be disincentivized from actually employing people who don't have permanent residency, as an example. They state in relation to population growth, the level of population growth has been revised higher again, reflecting stronger than expected net overseas migration. Year-ended population growth is assumed to have peaked in the September quarter at around 2.5%, after which is expected to decline back toward its pre-pandemic average of around 1.5%. So we've definitely got population growth. However, not necessarily the infrastructure or housing to support the population growth as appears to have emerged. And this then leads me on to inflation. And the RBA had a rather negative tone about inflation, by which I mean the RBA appears to expect inflation to remain higher than had previously been expected. They state, inflation is forecast to decline to 3.5% by the end of 2024, and to reach a little below 3% by the end of 2025. The forecast decline in inflation is more gradual than anticipated 3 months ago, because domestic inflationary pressures are dissipating more slowly than previously thought. That is, there is more aggregate demand, and this is propping up various parts of inflation. In relation to services inflation, they say, services inflation remains high and was the primary driver of the stronger than expected underlying inflation in the September quarter. This reflects the still strong level of demand for services, as well as the recent strong growth in domestic costs, including for labour, partly because of poor productivity outcomes, and non-labour business inputs such as energy, rent, and insurance. Speaking to rents in particular, the RBA says, rents have increased at an annualized rate of around 10% over the past 6 months. and rent inflation is expected to remain broadly around this rate for the year ahead, before easing gradually. Housing supply has not kept pace with the increased demand for housing from the decrease in the average household size since the beginning of the pandemic. Robust nominal income growth and strong population growth contributing to the very low vacancy rates and high rent inflation. In essence, we've got a few things here driving up rents. And if rents have increased 10%, that's clearly going to feed in to people's disposable income, making them feel and actually be much poorer for longer. But the sad fact of this, however, is that no one is actually getting any wealthier from this other than maybe the banks and the government. If you look at what's happening here, rents might have increased maybe 10% over the course of the year, but costs for landlords have increased by more than that. So let's use a really rough example. Say there's $1 million property. Let's be very generous to the rent earned on this. Let's assume it is earning $1,000 per week, which is very unlikely to be the case. That's probably going to be the ceiling on what could possibly be done. However, it won't be rented out for all years. There might be a transition in the tenant, and during that transition, you might at least have a week of vacancy. Now, we've got very low vacancy rates at the moment, but it might not be guaranteed you can actually move a new tenant in exactly when the old one leaves. So you might end up with 2 weeks of vacancy, so 52 weeks during the year. However, when a property is rented out, then the real estate agent might take a week or 2 weeks of the rent as their fee, and this therefore could potentially bring down the number of weeks rented to 49 or 48 weeks per year. So your actual income, your revenue, is going to be about $50,000 per year. But what then about the expenses? Because that revenue doesn't tell you the full side of the story. And if expenses have increased, then you actually aren't any better off. So say we look at this. At the moment, mortgage rates are around 6.5%, depending on exactly what the situation is. So you've got that 6.5%, and that will translate into about $65,000 worth of interest per year. So automatically, you are behind. Even earning $1,000 per week, you are still losing about $15,000 just on interest. Then you add on to this the various other costs. So there might be strata fees. They might be, for example, $1,500 per quarter. There would be another $6,000 per year, taking you up to over $70,000 in costs. Then you add on any other duties that might arise. So either council rates, or if it's a land that you own, add on land tax, potentially on that property. And in any case, what we can immediately see is that landlord is losing money on that property, because that roughly 5% yield is simply below the cost of capital. It's simply below the interest rate, let alone all of the other expenses like strata, like council rates, like any repairs that come up. So no one is actually getting richer on the back of this. Banks might be, as we've seen from the record earnings from companies like Westpac. However, the individual owners are not. Perhaps the state government might be in some cases as well, if you look at the tax grabs in places like Victoria, although that isn't necessarily the case across all states. State governments appear to be going out of their way to try to raise more revenue, in large part because if you look at Victoria, they've got a massive deficit, and financing that deficit is going to come from debt, which is getting more and more expensive. Other states do the same thing, albeit to varying extents, and therefore we end up with a bit of a housing crisis percolating along. And this therefore manifests in wages that if we just look at it on inflation-adjusted terms, wages are going down after adjusted for inflation. It appears people are going backwards. And this is even ignoring those cases like I mentioned before. It's just looking at wages versus inflation. It's not looking at wages versus other things such as interest costs. Not only that, you need to consider this on an after-tax basis. So if wages go up 4%, but inflation is 5%, well, you're behind from the get-go, but then that 4% wage increase, that's going to be a little bit lower on an after-tax basis, so therefore you're even further behind here. And in large part, that can be due to things like bracket creep as well, where the actual tax thresholds are set at hard numbers, not at things that will go up with inflation. And the government doesn't appear to have any will to actually go and fix this. The stage 3 tax cuts go a little bit of the way, but the actual benefit obtained from those is capped at $10,000. It isn't a solution to actual bracket creep, but in any case, everyone is feeling poorer. Wages aren't keeping pace with inflation, expenses have gone up much more than inflation, particularly for some people such as landlords on mortgages due to the higher costs of interest rates. So everyone appears to be poorer for longer. At least the RBA appears to be honest about this.